All right, so now we are discussing the loans and guarantees. Now, again, like these are the situations which can give rise to the ethical threats. And due to those ethical threats, the independence of the auditor may be compromised. So basically what the ACCA code is doing, they are telling you the situations in advance so that you just understand those situations, you understand the relevant threat, which can it give rise to, and then you place the safeguards in order to avoid from those ethical threats. So the loans and guarantees, again, loans means giving the loans to the audit client or taking the loans from the audit client. And then we have the guarantees, like giving the guarantees or taking the guarantees from the client. Now, a guarantee is giving the guarantee to the financial institution. Like, for example, if your client needs a loan and they're not meeting the requirements, or for example, they're not having the collateral, and then you personally say to the financial institution, such as the bank, that give them the loan. If they're not paying it back, we'll pay on behalf of them. This is the guarantee, or vice versa. Like they do it for you. So the ACCA Code of Ethics says that, first of all, the firm should not give the loans to the audit client, because obviously the firm does not have anything to do with the loans, why they are giving the loans. The firm should not get involved in such financial arrangements. So the audit firm should not give the loans to the audit client because they have a very independent relationship when it comes to the audit and assurance. They should not get into such arrangements, the financial arrangements. Now there's a scenario whether the firm can take the loans from the audit client. So we have to see whether the assurance client, the audit client, is a financial institution such as bank or not a financial institution. So say, for example, they are not a financial institution, they are not bank, they're not someone who is supposed to give the loans as an ordinary activity of the business. Then you cannot take the loans from them, because if their business is not to give the loans and they are giving you the loans, so that means it's a favor, and it's a significant favor you cannot accept, because if you accept it, your independence and objectivity may be compromised. So if the client is not a financial institution, they are not a bank, they're not the institution who is supposed to give the loans as an ordinary activity of the business, so you cannot take the loan from them. And the second scenario is, if the client is a financial institution, they are a bank, then we need to see whether they are giving the loans on the market terms, like the commercial rate, the rate or the terms on which every other bank is giving the loan, and they are not giving you any preference, they're not giving you any favor. So then you can accept the loans from them, because obviously you can now, if this is the case, you can take loans from anywhere. So if they're giving you the loan in the commercial terms and there is no favor involved in it whatsoever, then obviously that means nothing can compromise your independence, because you're taking the loans on the market terms. But if you're giving you the loans, if they're giving you the loans on the preferential terms, now preferential terms mean they're giving you any sort of preference, for example, giving you more installments, keeping no collateral, reduce interest rates, or any other thing, any other term that they are compromising to give you the loan, then this is a preference, and you cannot accept the loans on the preferential basis, because this gives rise to the significant self-interest threat. So the safeguards are, for example, if they offer you such things, like if they offer you to give the loans on the preferential terms, so you can politely refuse. And for example, if there is someone who has already accepted the loans in the previous years and they are on the preferential terms, so do not involve those individuals in the audit team. So this is the loans and guarantees. Okay, now we have the overdue fee. Now what is this overdue fee? Overdue means pending, and outstanding. Outstanding means which is still remaining. So say, for example, you are doing the audit of, let's assume 2020, and the audit fee or any other assignment fee is remaining from the previous year. So this remaining fee, this unpaid fee, give rise to the self-interest and intimidation threat. Now, how this is the self-interest threat? How the unpaid fee remaining and outstanding fee is a self-interest threat? Because, for example, if fee is remaining, then in order to recover the fee, I may get lenient towards them. I may not. I may try to keep them satisfied, just to make sure that I'm recovering the previous fee. So if I'm getting lenient towards them, giving some favor just to make sure the previous fee is recovered, then this is the self-interest, right? And intimidation is when they say you such thing, like for example, if you're not doing the audit according to us, or for example, if you are taking too much time in the audit, you are being too skeptical, you are challenging the things, then we are not going to give you the previous fee. This is an intimidation. So the ACCA Code of Ethics states that the fee should be recovered before the audit report is being given. So the audit firm, what they should do, they should take the fee before they have submitted, the report to the audit client. So first of all, they should try to recover their fee. But if still the fee is remaining, so what they can do is they can discuss this matter with the client's audit committee. Now we have discussed this thing, that audit committee is a committee consisted of independent non-executive directors who make sure that the audit function is independent. So what you can do is you can discuss this with them, that the fee is remaining, and like we are supposed to get it in order to be independent. So make sure you give us the fee, because we are doing business. It's not a charity we are doing. And then an independent person reviewing your audit file. Now, why you are doing that? Because fee was remaining, you stood independent, you remained independent. Now you're making sure that, okay, if someone review your work, so that he can stamp, he can actually assure that your independence was not compromised due to the pending fee issues. So although you remain independent, but someone else independent reviewing your work will give you, a confirmation which you can submit to your professional body as well. Like, look, see, we were independent. We have been given this thing from the independent partner as well. And there's another safeguard, the last resort resign. Like if you still feel that they're not going to give you the fee, and you only have to do some legal action in order to recover the fee. So first of all, you should resign, and then you can take the client to the court. But we are not going to write this take the client to the court thing, because here we are just studying the ethical safeguards. So the last resort, what you can do is you can simply resign if the fee is no longer recoverable. So why you are doing the audit if they're not going to give you the fee? So you should not do that. Okay, then we have the contingent fee arrangements, contingent fees. Now, what is this contingent fee? Contingent means dependent. When your fee is dependent on some outcome. Like for example, if your fee is dependent on the profit for the year, if your fee is dependent on the total assets, if your fee is dependent on the revenue. So this is the contingent fee arrangement, which the ACCA Code of Ethics does not allow, because this gives rise to the significant self-interest threat. Like, because we are there to identify the material misstatement, we are there to tell them not to manipulate the financial statements, and if they've done the misstatements, we tell them to fix it. And they will be fixing those things, the profit will be reduced because they have exaggerated the profit. And since they are reducing the profit by removing the misstatements, our fee will decrease as well, which is not going to be in the favor of us, because our fee is based on the profit. So that is why ACCA Code of Ethics states that you should not have such arrangements, because otherwise you will have a clear self-interest, right? You will try to even manipulate their profit yourself in order to get more fee. So that is why ACCA does not allow such type of arrangements. And instead, the audit fee should be based on the level of work performed. See how many hours you will be spending over there, how much time you will be allocating over there, how much resources you will be deploying over there, calculate the cost of it. And this is the fee you can quote to the audit client. And so this fee arrangements are not allowed. And then we have the high percentage of fee. Now, what is this high percentage of fee? So remember, I have already told you that when you talk about the firm, so firm, they are providing many sort of services. We talk about the firm, there's a taxation department, advisory department. Within advisory, there are classes, corporate advisory, business advisory, legal advisory, so many things. Then the valuation department, then the IT department, then ERP department, audit, other departments, recruitment department. There's so many departments within the firm. So we can classify those services into assurance services, which includes the audit and review. And then we have the non-assurance services, which are other services in which we are not giving any sort of assurance. So the firm revenue basically comes from assurance plus non-assurance services. So if fee from one client, whatever you are getting from one client, including assurance plus non-assurance, is 15% or more of the total revenue of the firm. Like if you compare revenue coming from one client, divide by the total revenue of the firm, and that is more than 15%. Then that means it's a significant client. You're getting a significant proportion of your income from one client, and that means your dependency may be enhanced on them. And due to that dependency, your independence may be compromised. So this gives rise to the self-interest and intimidation threat. Now, the self-interest threat means you will never ever want to lose that client. You want to retain that client for whatsoever reason, because you're getting a significant amount from them. So in order to retain them, you may get lenience toward them, you may get less skeptical, you may give them unusual favors by being less skeptical, by testing less. So this is the self-interest. And intimidation is they know as well that they are paying you the significant fee. So they know that they're paying you a significant fee, so they can intimidate you that if you're not doing the audit according to us, if you're challenging so many things, if you are skeptical, checking everything, questioning, investigating, then we are not going to give you audit further. So this is an intimidation, and due to this intimidation, your independence may be compromised. So the possible safeguards are reducing the dependency on the client, like if it is practical, like if you can reduce some assignments, like this is possible. Disclose this to those charged with governance. That means the audit committee tell them that although you are providing them so many services, which earns you a lot of money, but still you have made sure that your independence is not compromised. And arrange for review to be conducted. That means tell someone to review your audit work so that it makes a stamp that actually your independence was not compromised by the fee issue. So if you are involved with the client in so many services that enhance your fee, and it reaches more than 15% of your total revenue of the firm, then this gives rise to the self-interest intimidation threat, and that means you need to place safeguards to ensure your independence. Okay, then we have the lowballing. Again, lowballing is something related to the fee as well. Lowballing is something related to the fee, and here we are talking about low fee arrangements. If when you're charging less than what other firms are charging in the market for the same service, like for example, if others are doing audit, let's assume in £50,000, and you quote for the same audit £25,000. Now, why you are doing that? So you are doing that in order to attract more and more clients. So this gives rise to the self-interest threat. Why you are doing this lower fee arrangements? Why you are doing the lowballing? Because you want to attract more and more clients. So you want to be competitive over there, price competitive. That is why you're doing that. Now, why the ACCA has the issue with it? Why the professional bodies have the issue with charging less fee if you can afford it? Because the thing is that by charging less fee, there is a threat that you may not be able to deploy quality staff over there. You may not spend appropriate time over there. You may not follow the quality assurance standards, the quality standards, the quality control procedures. So there is a risk with charging the low fee. Maybe you use junior and incompetent, untrained staff just to make sure your cost is less. So that will affect the audit quality. That is why ACCA is concerned regarding the lowballing as well. But make sure you are using the trained staff, you're spending appropriate time on the audit client, and you're using the quality control procedures. Even if with all these being placed, you're still charging the less fee, then obviously that will not be a significant threat then, because it ensures the quality. But in the longer run, it will not be suitable for the firm, because once you create a benchmark by charging less fee, then in future you cannot raise that, because that will be difficult for you. Then we have the recruitment services. Now, what is this recruitment service? Recruitment service means when you are recruiting people on behalf of the client. For example, they need someone in their departments, different departments, particularly the accounting, finance, audit, the similar departments. Now, this give rise to different threats. First of all, the self-interest threat, because when you are providing the recruitment services, it's a separate service for which you charge a good fee that may boost your fee level and that may go beyond 15%. So this will be a self-interest threat because you're charging high percentage fee from one client. The self-review threat is like, for example, you recruited some people for them, and then when you went to the audit, you saw that they have not done the work correctly. They have made a lot of mistakes, errors, omissions, let's assume frauds as well. Then you won't be able to challenge them because otherwise the client will be saying that these people are recruited by you. Were you being skeptical when you were deciding, when you were recruiting them? So that would be difficult to explain that why you had recruited them. So there is a self-review threat. And familiarity is, for example, if someone familiar to you goes to the client, let's assume someone ex-member of your firm, and you recruit them for them, and when you go to the audit, so there will be a familiarity with that guy. So independence may be compromised by having the family or personal relationship. So what is a safeguard? The safeguard is that you can do the shortlisting on client's behalf. Like, for example, if they tell you the criteria that they need certain people based on this qualities and attributes, so you can shortlist the client, the people for them, but you cannot take a management decision. By management decision, we mean the final selection. Don't do the final selection. So just shortlist the candidates for them and then leave on them that okay, we are done with the shortlisting. Now you can choose from these particular options. So that means you need to limit your liability regarding that recruitment. Then we have the recent service with an audit client. Now, earlier we stated the employment with an audit client, where someone from the firm went to the audit client, and then there was a familiarity for the people who were going to the audit now. Now, this is opposite. This is the recent service with an audit client. Someone from the audit client, such as financial controller, such as finance director, coming to the firm from the audit client, such as audit manager, such as the partner, things like that. So if they're coming from the audit client and joining your firm and they go to audit the same client, then this will give rise to the self-review and familiarity threat. How the self-review? Because they have done the work over there, they were responsible for making the financials over there, and now they're auditing the same company. Even the audit or review work, they cannot do that. So you should not involve those individuals in the audit team for consecutive 2 years, because there is a self-review threat and the familiarity, because obviously they were their ex-colleagues. Now we have the provision of the non-assurance services. Now the provision of the non-assurance services mean when you provide the non-assurance services in which there is no assurance. We know that, for example, taxation service, IT services, making the financial statements, and litigation support services, corporate advisory. All of these are the non-assurance services in which we do not give any sort of assurance. So when we provide the non-assurance services, different threats are arise over there. Self-interest, because it boosts your fee level. Self-review, in most of the cases you review your own work. We are discussing that thing in a while, so we are just generically discussing these threats. Advocacy means because you represent those, you present the client in those services. And then we have the familiarity, because you are attached with the client for so much time, give rise to the familiarity. And then we have the intimidation. Sorry, intimidation is when the client threatens you or pressurizes you, because your dependency on the client has been enhanced by providing so many services, so they can threaten you. So this is the general slide. Now we will be talking about one by one the non-assurance services in detail. So first thing we are having right now is the preparation of the financial statements. Now, there are two contexts in it. Like when you talk about the preparation of the financial statements, so you see whether the client is listed on the stock exchange. That means a public limited company, or you can say a public interest entity. So it's a public interest entity, or it's not listed. Not listed means unlisted, unlisted or a private company. So if the client is a listed entity, they're public interest clients, then that means you cannot prepare the financial statements for them unless and until there's an emergency. Now, emergency situation means, like for example, there is no one with them to help them with the financial statements, and the work is not very much, and there's a very less fee for the work, and your independence cannot be compromised in that such situation. So you can do that. Otherwise, the financial statements cannot be prepared for the listed entities. Yes, for the private entities, you can do that. That means unlisted entities with safeguards. And the safeguards means you should not accept any responsibility. Just do the work on the client's behalf according to their accounting policies. Do not make any policy. Do not sign any documents. Do not decide any accounting treatments. Just make sure whatever you are doing is told by them, is their policy of doing it, and you are not deciding anything from yourself. And when you are preparing the financial statements, you should make sure you are using the different team as well. But for listed entities, financial statements should not be prepared. And now we have the valuation services. Now, valuation services mean when you are valuing the assets of the client. For example, you're valuing their property, plant, and equipment. You're valuing their investment properties. You're valuing their pension funds. In that case, when you are giving them the valuation services, you actually decide the figures that should be allocated to those assets. And then those figures become the part of the financial statements which you are auditing. And when you audit them, that give rise to the self-review threat, because you are auditing your own decided figures. So the ACCA Code of Ethics states that you cannot provide the valuation services if the figures are material to the financial statement. That means the significant proportion of the financial statements. And the second case is the valuation where there is a significant degree of subjectivity. That means there are estimations involved. Like when you study the financial reporting, you see there's a standard IFRS 13, the fair value measurement, which says that, okay, the step one is this. On the step one, you see the active market of the same asset, and then the similar assets. And then you estimate the values for some assets because their active market is not available. So if there are significant figures for the financial statements and there's a significant degree of subjectivity being involved, that means you need to take the estimates to give the figures to the asset, then you cannot do that. So the safeguards would be the client acknowledging the responsibility. Again, you should not decide the mechanism for the valuation, the tools you're using for the valuation. Just do the valuation according to their criteria and do not do anything from your behalf. Okay, now we have one of the most important services we see within the ethics question, that is the taxation service. Now, within the taxation, there are 4 types of services. So number 1 is the tax return. Number 2 is the tax calculation. Number 3 is the tax planning. Number 4 is helping the client in the tax disputes. So these are the 4 services. So when you talk about the tax return, nowadays we know these are the electronic returns. We can do that for the client. So it does not pose any threat as long as you're not taking any management decision and management responsibility. So whatever you are doing, just do according to whatever tax law says and according to the client's policy. And do not take any responsibility of the work done. Then we have the tax calculation. It has the same rule as for financial statements. You cannot do the tax calculation for the listed entities because it poses a significant self-review threat. Because when you're doing the tax calculation, that becomes part of the financial statements, and then you audit the same financial statement that give rise to the self-review threat. For private entities, you can do that with safeguard. That means unlisted entities. Then we have the tax planning. No, tax planning is the tax advisory. So tax planning is the tax advisory. So can you advise the client on regarding the tax matters, how to save the tax and how to be in the lesser bands in order to save the tax? So yes, you can do that if your guidance and advisory is with reference to the tax law. Whatever you are telling them is a legal thing, that how to save the tax. But if it involves significant judgments and estimates and that can lead to the tax evasions, then you cannot do the tax planning for them. And then similarly, the helping the client in the tax disputes. For example, if they're having tax dispute with the tax authority regarding any figure, regarding any calculations, so you can do that generally. But if the figures are material to the financial statement, then you cannot do that. So this is the taxation for you. The four services involved within the taxation is the tax return, tax calculation, tax planning, and helping the client in tax disputes. Okay, then we have the internal audit services. Now, again, it makes quite sense that we know this thing, that the system produces the financial statement. When you talk about the system, it involves sales system, which produces the sales figure, purchase system, which produces the purchase figure, payroll system producing the payroll figure, and similarly, etc. So if you are providing the internal audit services to the audit client, that means you're working on their internal control system. And that system which you are making or implementing or reviewing produces the financial statements. And that financial statement is subject to the external audit, which you are doing as well. So this gives rise to the self-review threat, because you are working on the system which produces the financial statements, and then you're auditing the same financial statements as well. So that means this gives rise to the self-review threat. So ACCA Code of Ethics states that this should not be performed, the internal audit services should not be performed on recurring basis, regular basis, if it is related with the financial reporting. So usually it is related to the financial reporting. Another safeguards include that audit committee should decide the scope of the work and different teams and etc. So these will be the safeguards. In the exam, we are not supposed to write all four ones. I've already communicated to that. So what you can do is simply uh, yes, write a single or one or two safeguards. But for example, if it is about the NMCQs, over there you can simply see what sometime examiner asks you what is the most appropriate safeguard, what is the least appropriate. Then you can use all these four in order to analyze what is the most appropriate and least appropriate thing. Then we have the corporate finance and similar activities. Now, corporate finance and similar activities mean that the client needs the finance either from the equity or from the debt, for example, issuance of shares or taking the loans or issuing the debentures or loan notes. And they want your support in that. For example, they want you to assist in the share issuance process, motivating the people to buy your company shares, and they just want you to represent them in front of the taxation authority, the banks, in order to give the loans. Then this gives rise to this advocacy and self-review threat. Advocacy means when you're representing them in front of potential investors. So advocacy is simply, let me just write over here, is when you're representing them in front of banks, for example, to give them the loans, or potential investors and motivating them to invest in this company. So this is an unusual advocacy, which the ACCA Code of Ethics does not allow. The self-review threat is, for example, when you are preparing, financials for them in order to be presented in front of shareholders, potential investors, banks, then that give rise to a self-review threat, because those figures which you produce are being presented to the banks and then become the part of the financial statement as well, and then you audit the same financial statements. So this is the corporate finance and similar activities. Then we have the IT system services. Now within the IT, we need to see whether these IT services are related to financial reporting or unrelated. Like, for example, if they are related to financial reporting, such as or accounting softwares, internal audit software, stock count softwares, where the figures produced become the part of the financial statements. In that case, that give rise to the self-review threat, because you prepare the software and software produces the figures that become part of the financial statements, and then you audit the same financial statement, that give rise to the self-review threat. Unrelated services, nowadays we have so many things. We have the automation, robotics and things like that. So for example, if they are automating any manual function, this is an IT service as well, which you can provide, nothing to do with, or less related with the financial statements. Then we have the litigation support service. Litigation means a lawsuit, for example, if they are involved in some sort of cases, legal cases, and they want your support in that. For example, now support means they want you to act as a witness, they want you to calculate the damages, they want you to prepare the evidences for them. In that case, this gives rise to the self-interest, self-review, and advocacy. Why the self-interest? Right, because you will be charging fee, significant fee for this legal help, and that boosts your fee level. In that case, like your dependency on the client is enhanced. Self review is when you're calculating the damages for them to be presented, for example, in the court, or for example, to sue anyone and claiming for the damages. So if you are calculating the damages for them, and then that become part of the financial statements, for example, in case if there's a case in you, then you record that thing as a provision, or for example, if you want to recover that amount, you record that as an asset. Let's assume if the inflow is virtually certain. So that means that give rise to the self review thread, because you are deciding the figures that become part of the financial statements, and then you review the financial statement yourself, audit the financial statement yourself. It's a clear self review thread. And then we have the advocacy. Advocacy means when you are representing them in front of the court, legal authorities, and you are taking their position, so that give rise to the advocacy. The safeguards are the same: should not take any management decision, you should involve experts, where you should participate, where you should note. So these are the safeguards. Similar is the legal services, giving the same threats. And then we have the actual and threatened litigation. Now, this actual and threatened litigation means that the client has actually sued you or threatening to sue you. Why they will be threatening you? For example, they may tell you, like, if you're not doing audit according to us, we may sue you that you have not delivered what was expected to be delivered, and you were not skeptical, and you didn't show the due care and diligence. Obviously, even if you have done that, everybody wants to avoid these cases. Nobody wants to go to the court and explaining their position, because it takes time. You're not there, you're just there for the business. So sometimes the firms get intimidated, and if they think themselves that, for example, if they they may sue you, or they may take you to the court if you're not doing according to that, then that is a self-interest, because you yourself want to be in a situation where you are avoiding such threats, and you just accept whatever they tell you. So that is a self-interest, right? Intimidation is when they tell you such things, that we're going to sue you, we'll take you to the court, and things like that, and you get intimidated by that, and you just accept whatever the client is saying. That is the intimidation, right? So if it is about a particular individual, for example, sometimes it happens that you have someone in the audit team who is not having any chemistry, or an affiliation sort of thing with the audit client, and there's a lot of personality clashes as well. So what you can do is you can simply remove that individual from the audit team, rather resigning from the audit and things like that. So be practical. If it's about a or two individuals who is being a problem to the audit client, and they want someone else to be part of the audit team, so just do that, because you're doing a business, and in the business, customer is always right, so you just try to adjust them. In other cases, you can discuss with this matter with the client's audit committee, and involving an independent person to review your work. And then within the ethical threats, this is the last slide. The rest are part of the ethics, but that does not relate to the ethical threats and the safeguards. This is the last slide, which is the long association of senior personnel with the assurance clients. So what is this long association? For example, if there is a partner, key audit partner, or for example, an engagement partner. An engagement partner means someone who is responsible for signing the audit report. Key audit partner means, for example, someone who is responsible for the review partner, the one person who reviews your audit work. So whether engagement partner or the key audit partner is involved in the audit and reviews of same client for more than 5 years, then ACCA Code of Ethics states that there is a significant familiarity between these individuals with the audit client, So this creates a familiarity threat, and these guys should be rotated. By rotated we mean, like for example, there are different partners within the firm, so you can take the assignment for them and give it to the other partner. So you rotate it on the routine basis after 5 years, and then the same partner can come back after 2 years. This is what ACCA Code of Ethics suggests. Within 2 years, the familiarity will be at least somehow eliminated, and they can, start after another 2 years auditing the same client. So this is the long association of the senior personnel with the assurance client. All right, now we have the remaining portion of the ethics, in which we are discussing some other straightforward topics such as the confidentiality principle. We have already discussed it, that the general principle is that you should not disclose the information to any other person without client permission. But there are exceptions to it. For example, the obligatory disclosure. Here you are obliged to disclose the matter to the relevant authority if client is involved in such activities such as treason, terrorism, drug trafficking, human trafficking, money laundering, any illegal activity which can, threat the state and their members and their public. So you should report this illegal activity. If you are hiding it, concealing it, then if it is become apparent later on, you will be in charge of concealing as well. So you will get the charge for it as well. So make sure if you see anything, you just directly report to the relevant authority. This is an obligatory disclosure where you are supposed to do that, obliged to do that by law. And then we have the voluntary disclosure. Voluntary means where you have a wish, choice, your wish, whether or not to disclose it. For example, anything which is in the public interest. For example, the client is using, let's assume, a cheap quality material. Now, cheap is not something illegal. So low quality material, not something illegal. They can use that. But you believe that, okay, it's not something in the best interest of the public, so you disclose it. Well, now this is up to you, such as legal process. Like, for example, there is a legal case going on regarding the client, and if you have such information, if you give it to the court can solve the case easily. But again, that is not obligatory. It's a voluntary thing if you want to just do that, so to help the legal process. So this is all about the voluntary disclosures, exceptions to the general principle of the confidentiality. Now we have the conflict of interest. Now the conflict of interest means when you're auditing two competitors, for example, Pepsi and the Coke. Let's assume they are competitors. Yes, Pepsi and Coke at the same time. Now, if you are doing that, so there's a possibility, although the Pepsi and the Coke, like it sounds like the competitors, but the institutional investors are same, so they already know what is going on everywhere. But let's assume for an example that they are significant competitors, or for example, any company, let's assume McDonald's and KFC. So they are competitors selling the fried chickens, let's assume. So if you're auditing both, so there is a possibility that information of one can be transferred to the other, and this can affect their business and confidentiality thing. So there's a conflict of interest. So between two competing clients. So if you're auditing two competing clients, then you need to put safeguards before the audit process, such as careful management of clients, make sure the information is not transferred from one client to another, use different team, that means Chinese wall. So there should be separate teams, and they should be bound not to disclose the information, even if you have to sign the confidentiality agreements from them. So just take the undertakings from them that you will never ever share the information of one client to the other. Okay, then we have obtaining and accepting a new client. Whenever you are accepting a new client, make sure you always behave in a professional manner. That means following the laws and regulations, avoiding action that discredit the profession. Do not advertise your audit work or audit firm in a way that you result in claiming unusual things. For example, if you say we will give your business a kickstart, in the audit you have nothing to do with their business. Or for example, we guarantee you that the financial statements are correct. You cannot give the guarantees. Or for example, after the audit, your business will grow up. We cannot claim such things. Or for example, you are the best auditors in the world. Who has given you this certification of being the best auditors? So the firms cannot advertise in this way that results in false and unusual claims. Okay, then we have the quoted fee should be based on the level of work. You cannot do the contingent fee arrangements. We have already discussed it. And no commissions paid for introduction. Like for example, audit is done through the tendering process. When we say tendering, then whenever the client needs the services, they just announce it and different firms submit their proposals. So just do not end up paying the bribes to someone within the audit client. Just give us the audit and I will give you 10% of fee, 20% of fee. So do not do that way. Just make sure that your proposal and the tendering process is quality assured, so that you just get the services rather than you have to pay the bribes. Okay, before accepting, then you need to see the precondition. This is very important, already tested many times in the exam. The precondition means that whenever you're accepting the client, there are certain things that should exist, otherwise you will not accept the audit. The first one is that there should be a financial reporting framework. When we say the financial reporting framework, that means the financial statements should be prepared according to the set framework, like IAS, IFRS. You should know the framework. Otherwise, you won't be able to, audit the financial statement, because you need to compare them with the suitable criteria. We have already discussed it in the assurance engagement process. So there should be a financial reporting framework, and then the responsibility of the management regarding what? Regarding three things: that the preparation of the financial statement is their responsibility, the internal controls related to the financial statements is their responsibility, and they will provide us the access to the records and the personnel. If they agree these things, that they, okay, there is a reporting framework and they will give us the access, they are responsible for preparing the financial statement, they're responsible for the internal controls, then we can accept the audit. Otherwise, if they refuse to do that, we cannot accept it. And in the other pre-acceptance consideration, we need to consider some other factors such as the fee issues. Can we meet the deadlines? We will be able to get the fee, the reputation of the client, see whether are they known for not giving the fee, then why you are accepting the audit? Are they known for illegal activities? Then do not put yourself in trouble. So things like that. And then there's one of the most important thing, that is professional clearance. Like when you are being given the opportunity to do the audit, someone else was doing it earlier. Take the professional clearance from them, and is a professional process. Ask them why they have left it. Were they having any professional issues? So you ask the client, can I contact the previous auditor? If they say no, so just refuse the audit. Because if they're not allowing you to contact with the previous auditor, that means there is something wrong with it. And if they allow, okay, fine, then the previous auditor will be contacting the client whether I can reply to the new audit firm, prospective audit firm. If they say yes, so see if you have got the relevant answers and there is no professional issues involved in it, then you can accept the audit simply. If you believe there are some audit issues, there were some fee issues, independence issues, or evidence issues, then you should not accept the audit. And then make sure when you are accepting the audit, the previous auditor has resigned and your appointment is valid, and you have signed a proper engagement letter with the audit client, which is a contract between the audit firm and the audit client. And there are certain matters on it, which means we will write the scope of the audit, because obviously we are doing the audit for the shareholders. It's not for everyone. It's not for the banks. Maybe a bank can give the loan to the audit client after looking at our report, and then later, if they are not able to pay it back, they say, you have given this report. So this report is not for the bank. This is for the shareholders. So we'll write our responsibilities in it. We'll write the management responsibility in it. We'll write any exclusion clauses, for example, that we are not going to give the guarantees and things like that. We'll limit our liability regarding certain matters as well. So these are the things we write in the engagement letter. Already examiner has asked this thing many times. Write the 5 elements which include within an engagement letter. So you just should know 4 to 5 elements to write in an exam question. So this is all about ethics.